Just this past weekend, we did a video taking a close look at Realty income stock, trying to answer the question whether or not we think it's a safe stock for high yield dividend income investors. And the answer that I came down with was yes, I think it's pretty safe. Good yield, it's well protected by solid cash flows, great business, wonderful operations, good debt structure, strong balance sheet. They answered all of those questions with a resounding yes. And then what happens? Monday, we get news the Realty income is going to make a big acquisition. It's going to invest more than $9 billion in total enterprise value to acquire Spirit Realty Capital. Now, you have to be wondering, the stock fell on that news. Is this still really a safe stock? Is it worth owning or not? Do we need to reevaluate the business? I'm Jason Hall. This is The Smattering. We're going to take a closer look at Realty income and this deal that they've just reached. But first, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link, fool.com/The Smattering, and The Motley Fool is going to give you its 10 best stocks to buy right now. Okay, let's take a look at what's going on with Realty income stock today. Stock price, again, you see it, this purple, it's down 5.3% on the news of this acquisition of Spirit Realty Capital. All right, so we got an acquisition happening. This is not out of the ordinary. Realty income is a pretty acquisitive business. Generally, though, they're buying assets. They're not buying entire companies. They don't do a ton of that. So this is a little bit different. So let's start with this. What is Spirit Realty Capital? To help answer that, I'm going to pull up Spirit Realty Capital's most recent investor presentation, and we can take a look and see who are their largest tenants and what areas do they own properties in to help answer that question. So you can see right off the top, a lot of these names look really familiar if you're a Realty income investor. BJ's, Walgreens, CVS Pharmacy, AMC Theaters. These look pretty familiar because they are companies that Realty income already does business with that are their tenants. Now, we've got some other ones that might not be familiar to you. Shopko. We're also adding Home Depot. Right now, Lowe's, one of Realty income's larger tenants. So what do you see? Mostly a good bit of similarity. That's good because for the most part, the tenants and the kinds of businesses that Realty income does business with are relatively e-commerce resistant businesses, and they're also resilient during a recession. So for example, during a recession, Home Depot's not going to miss their rent payments on their real estate. So those businesses might struggle a little bit more during the recessions, but they're not going to have any trouble paying their bills. And that's super duper important. Then you look at major industries that Spirit counts its biggest tenants. And again, you're going to see some familiar stuff: general merchandise, restaurants, convenience stores, the experiential businesses, and the staple real estate that is the core of Realty income's business. You're also seeing an increased mix in manufacturing and distribution. That starts to get a little tiny bit maybe outside of what Realty income has been best at and focused at and over the years, but it does add some nice tailwinds in some areas that there is good potential growth in North America. So overall, it looks like it's acquiring the sorts of assets with these properties that are part of Spirit that do make sense. It fits within its existing business, its core competencies, the sorts of industries that it knows, the kind of tenants that it has a history of working with, the same kind of properties that they're already leasing to tenants right now, those standalone properties with triple net leases where the tenant's responsible for, they pay their lease payment, they're responsible for insuring the property, for maintaining the property, and also paying taxes on it. So all of that kind of fits the same bill. Now, the next question, are they paying a good price? And I think there's a couple of ways that you can look at it. We're going to take a look at the enterprise value. So what is enterprise value? That is the business plus debt that you would have to assume when acquiring the business. So works out to about $8.4 billion is the closing value the day the acquisition was announced. Now, Realty income said they're buying it for an enterprise value of about $9 billion. Here's the thing, it's an all stock deal. So the amount of stock that Spirit Realty's investors is getting is going to basically be the same. You got to remember, Realty income stock came down 5% after the deal was announced. And if you look here over the past several years, $9 billion, that seems pretty fully valued for Spirit Capital. It's below the peak that we saw when it approached $10 billion a few times, but $9.2 billion is the kind of the round number that they put out there. And that sounds, again, a fully valued price. Certainly not cheap, They're not getting a bargain here, but you know what? There's a reason they're not getting a bargain. If you look at Spirit's assets, again, those are some great tenants, and those are exactly the kind of properties that Realty Income is familiar with owning and the kind of tenants they're familiar with leasing to and working with as tenants. So that part makes sense. There's another part of it that I think is pretty appealing and attractive if you're Realty Income right now, and that's the debt profile that Spirit Realty has. And the short version, without getting into all the nuts and bolts, is that the debt is pretty well laddered of its maturities. It doesn't have a bunch of debt that's coming due next year or the year after. The average maturity is about 5 years. So that gives Realty Income plenty of time to integrate and make sure that it's prepared to start refinancing debt over time, looking at its asset base, maybe determining there are certain assets that it may want to sell off. It can use those proceeds to pay down debt. The other big part that's really important is not just that the debt's well structured, it's cheap. It's the average interest rate on that debt is less than 4%. That's super duper valuable in this high interest rate environment that we're in right now. So I'm sure that came into play with the price that Realty Income agreed to pay to shareholders of Spirit Realty Capital. Put all that together. The next question you're going to want to know, you're going to want to try to answer, is this a good deal? Does it make sense, the price and how they paid? Because they didn't pay in cash, they're paying in stock. So in the video that we just did, when I reached the conclusion that I think Realty Income is a pretty safe stock, I reached the conclusion that I thought the stock was maybe not cheap, but it was certainly a really good value. And I will tell you, I think management might disagree with me a little bit. I think they might think their stock was maybe on the high end of the valuation. And I think that because they use stock to make this deal. Okay. But when a company buys, especially a company like Realty Income with a long history of being really good at capital allocation, when they use their stock to buy something, they usually do it because they think their stock value is a highly valued thing. It's not cheap, right? You don't want to use your stock when it's cheap to buy stuff. Use it when it's expensive to buy stuff. And this is a pretty big investment. So tells me that they think that the stock maybe is a little bit expensive for them to use it to buy a company fully valued, not at a big discount, to use their stock to buy it. Now, the hard part comes in integrating it, bringing it all together, making it fit, keeping the people from Spirit Realty Capital that make sense and add value, and trying to reduce cost where it makes sense. Some of that's going to be people, some of it's going to be assets that they spin off, and some of it's just going to be the ways that they can improve operations when they combine these two businesses. So that's going to be the real thing that's going to create the most value for shareholders, is their ability to really do that when they integrate these businesses together to get the most leverage out of the business. Now, one thing I will say is if you think about the stock yield for Spirit Realty versus the yield for Realty Income, there's a discount there. Spirit Realty stock yields over 7%. They're acquiring those shareholders at a yield of around 6%. So that's, again, cost of funds is basically about 6% to acquire this business. So it looks overall like it's a good move. Is it still a safe business? Yeah, I think it's absolutely a safe business, particularly for investors who are looking to hold it for the long term. That's the most important thing you have to remember, is this is, as a long-term investment, it looks good. Does this kind of raise the standard a little bit? And maybe should investors hold management to a really high level of accountability as they move forward with this acquisition, close it and start integrating? Absolutely. You got to make sure they actually deliver value as they integrate these assets together. Once we get shareholder approval and they actually do close the deal and begin the merger, then you really need to hold them accountable. This is a company with a long history of very good execution across acquisitions. Again, mostly assets, not so much whole companies, but I think they can get it done. And I think the price today represents a good value.